All right, let's dive right into this explainer. Today, we're looking at a frankly fascinating algorithmic trading system designed to completely tame market chaos. If you've ever stared at a stock chart and felt like it was just a giant wall of random unpredictable noise, well, you definitely aren't alone. But what if there was a systematic, purely mathematical way to see the underlying structure? That's exactly what we're going to explore today by breaking down the HMM Regime Terminal. It's an open-source project that leverages some seriously advanced statistical models to map out the hidden seasons of the market.
Here's a roadmap for today. First, decoding regimes. Second, the core HMM engine. Third, strategy confirmations. Fourth, forecasting markets. And fifth, the terminal dashboard.
You know, the stock market can feel completely chaotic, but quantitative titans have long proven that mathematical models can systematically find the signal in the noise. The creator of this project actually notes that the terminal was directly inspired by the pioneering work of Jim Simons and his legendary Medallion Fund at Renaissance Technologies. They famously used highly complex mathematics, including hidden Markov models, to extract pure signal from seemingly random price action. And this project? It aims to apply those exact same quantitative principles, but at a scale that's accessible for everyday data explorers.
Okay, let's jump into Section 1, Decoding Regimes, Hidden Market Seasons.
To make sense of the market, this system relies on a hidden Markov model, or HMM. By definition, an HMM is a statistical model used to detect hidden states and observable data. Think of it kind of like the weather, right? You wouldn't wear a swimsuit in a blizzard, and similarly, you absolutely shouldn't use an aggressive bull market trading strategy when the market is in a crash state. The observable data, so daily price changes and volume, are just the snowflakes or the sunshine. The HMM's entire job is to look at those daily clues and mathematically deduce the underlying season or regime that the market is currently experiencing.
Now, under the hood, this model is actually tracking 7 distinct microstates before simplifying them into 3 tradable categories. The source documentation reveals that the algorithm identifies highly granular substates. For example, a bear regime isn't just one blanket thing. The model distinguishes between a sustained decline and absolute crash/panic. On the bullish side, it can differentiate between an early recovery and pure momentum euphoria. But to make all of this actionable for a trader, the system neatly collapses these 7 complex substates into 3 broad tradable regimes: bull run, bear/crash, and neutral/transition.
Moving right along to Section 2, the core HMM engine, the Gaussian mixture model.
As we know, an algorithm is only as good as the data you feed it. This engine ingests 4 specifically engineered features from historical daily data to map out those hidden seasons, and it does this without any manual labeling. It looks at returns for daily directional momentum, the range for intraday volatility, vol change for abnormal spikes in trading volume, and trend return to capture the 20-day cumulative trend. By standardizing these 4 very specific data points, the model clusters historical days together based purely on their statistical fingerprints.
So, the specific architecture of this engine is a 7-state Gaussian mixture model. But what's truly fascinating here is that it utilizes 2 Gaussian components per state to capture multimodal market behaviors. So what does that actually mean in plain English? Well, think about a typical bull run. It's almost never a straight line up. Sometimes it's a slow, steady, quiet grind higher. Other times it's a violent, explosive gain. By using a mixture of 2 distributions per state, the math is flexible enough to recognize both the slow grind and the explosive pop as belonging to the exact same overall bull regime.
Let's get into Section 3, Strategy Confirmations and Execution.
The absolutely crucial point here is that this system triggers on changes in regime, not ongoing bars. It's transition triggered. The system waits patiently until the math detects a brand new transition from a bear or neutral state right into a bull run. Once it detects that shift, it checks a scorecard of technical confirmations. If those pass, it enters the trade. But here's the really clever part about its risk management. It demands consecutive bear bars before exiting. Market noise can so easily print a single ugly red day that makes you want to panic sell, right? By requiring multiple consecutive bear bars, which, by the way, is fully configurable by the user, the system avoids getting chopped out of a great position by a single day of statistical noise.
To filter out false starts like a dead cat bounce, the system layers 10 configurable technical confirmations on top of the statistical regime. Remember, the HMM is looking at the statistical pattern of a sequence of bars, but sometimes a single massive update right in the middle of a crash can trick basic momentum indicators.
That's why the system looks at up to 10 classic technical checks, things like the MACD, the average true range, and simple moving averages. They basically act like a bouncer at the door. You can tell the system, for example, to only take the trade if the HMM says we're in a bull state and at least 3 of these 10 technical indicators agree.
You can even benchmark exactly how much edge comes from the pure math by toggling off the technical indicators and running the backtester in regime-only mode. In standard mode, those technical checks are strict, but the developer built in a really cool toggle. If you switch over to regime-only mode, the system bypasses all 10 technical checks entirely. It'll buy and sell strictly on the moment the hidden Markov model detects a transition between market seasons. This is an incredibly powerful tool for a data explorer to figure out how much of their historical return is coming from standard technical analysis versus the advanced statistics alone.
All right, on to Section 4, Forecasting Markets. Looking forward.
Now, instead of spinning out a rigid, absolute price target, it runs a kernel regression, which is essentially a mathematical search for similar past patterns against historical data to project a weighted 10-day expected price path. Traditional forecasting tries to predict a specific dollar amount. This algorithm asks a completely different question. It asks, given today's exact cocktail of volume, volatility, drawdown, momentum, and regime state, what distribution of 10-day returns did similar historical situations produce? It mathematically searches the past, weights the most similar historical setups, and draws out an expected path forward.
And because the future is never perfectly clear, this expected path is rendered with a plus or minus 1 standard deviation confidence band, allowing traders to actually visualize statistical uncertainty. You don't just get a simple line pointing up or down. You get a dashed pathway wrapped in a shaded zone. This visualizes the reality of probability. It tells you not just where the price is historically likely to go, but the historical margin of error around that movement, which is obviously critical for understanding your risk and sizing a position appropriately.
But what if you don't want to just look at one single stock? When scanning the S&P 500 or NASDAQ 100, the multi-index screener ranks thousands of stocks by a composite score out of 100 to find the freshest, highest probability bull runs. It awards up to 40 points based on the mathematical probability that the stock is in a true bull state. It adds up to 35 points based on how many technical confirmation signals are flashing green. And this is brilliant. It awards up to 25 points for freshness, meaning it heavily penalizes a trend that's already weeks old and heavily rewards a trend that transitioned into a bull regime literally today.
Finally, Section 5, the Terminal Dashboard. Bringing it all together.
All of this Python architecture culminates in a really sleek, real-time UI that overlays your technical scorecard and forecast right over a dynamic price chart colored by market regimes. So you aren't just staring at a dry spreadsheet of data. The application fetches live data, displays a TradingView-style chart, and literally paints the background of the chart green for bull, red for bear, and yellow for neutral based on what the HMM finds. Right next to it, you can instantly compare how the algorithmic strategy's equity curve historically performed against a simple buy-and-hold approach.
Since different assets have completely different volatility profiles, a tech stock doesn't trade like gold, and gold definitely doesn't trade like crypto, the built-in optimizer grid searches up to 420 parameter combinations in seconds to find the maximum historical return. It will systematically test different combinations of how many consecutive bear bars are needed to exit, how many confirmations are required to enter, and how many days a position has to be held. It computes all 420 possibilities near instantly to surface the optimal historical settings for whatever specific asset you're looking at.
Now, as incredible as this tech is, we absolutely have to emphasize the project's own disclaimer. This is a highly objective statistical tool exploring historical data, not a crystal ball, and definitely not financial advice. The documentation makes a very clear, scientifically honest point. These regime labels are in-sample statistical artifacts. Just because a mathematical model beautifully categorizes the past doesn't guarantee it will perfectly predict the future. This terminal is a lens to view historical data more clearly, not a guarantee of future profits. So, I want to leave you with this thought. If the math can actually find the hidden seasons within daily market chaos, how might you adapt your own logic to survive the statistical winter? Whether you're a seasoned quantitative researcher or just a casual observer of the markets, looking at chaotic data through a structured mathematical lens really forces us to question our own biases. The signal is absolutely out there in the noise. The only question is, what model will you use to find it? Thank you so much for joining me for this explainer, and as always, keep questioning the data.